Good evening, everyone. Welcome to another live streaming of basic transfer pricing. Tonight, our discussion will focus still on the case of Coca-Cola versus the Commissioner of Internal Revenue, uh, which is the United States, no, Commissioner of Internal Revenue. And shout out na tayo, Ari. Okay, and thank you sa ating mga viewers po. Thank you for watching. No, kahit na tuloy-tuloy lang po tayo on our basic transfer pricing. And just a reminder, no? Pero bago niyan, pasalamat muna ako sa ating mga subscribers. We already have 444, no? 4 na mga subscribers. So, thank you very much for our subscribers, and for those who have not yet subscribed, please subscribe to our channel. And before we'll come to our discussion proper, I would like to remind, no, na yung ating income tax return is already due on April 15. So if you have to prepare your transfer pricing documentation as early as now, dapat nagpe-prepare na kayo, no? Especially yung nagpapa-prepare pa ng kanilang mga transfer pricing analysis, then it's very important kasi it will take time. Hindi po yung transfer pricing, hindi po yun kagaya ng mga regular natin na income tax return, no? Ito ay documentation po ito, no? Mas naiiba at mas tedious siya kumpara sa regular po na audit. Okay. So, let's continue with our discussion on Coca-Cola versus the Commissioner of Internal Revenue. And what is this case all about? Ito po ay appeal, no? Para sa mga viewers natin na ngayon lang attend dito sa ating live streaming. Ito pong case ng Coca-Cola versus Commissioner of Internal Revenue. This is an appeal case of Coca-Cola because na-assess po siya ng Commissioner of Internal Revenue for the year 2007 to 2009 assessment of more than 3 billion, no? More than 3 billion. At ano po yung cost ng assessment na yon? It's a transfer pricing audit. At ang dinisalaw po nila yung royalties paid to other subsidiaries, just like the in Latin America. Yung bayad ng royalty sa US is underpaid, pero nag-overpaid naman sila doon sa ilang subsidiaries nila in Latin America. So ano yun? Pina-adjust, no? So, kasi sobra-sobra yung when it comes to percentage, no? Sa profit method, sobra-sobra kaysa doon sa comparables, yung profit na doon sa Latin America to the detriment of the US company. So, yun yung sinabi ng US IRS na kulang yung income na dineclare mo sa Amerika kasi doon mo siya dineclare sa Latin America, Chile, Brazil, no? Doon na-declare ng Coca-Cola yung kanyang income. Kaya kulang yung binayaran niya na tax sa Amerika. So, nagkaroon ng adjustment during the transfer pricing audit. And the result is more than 3 billion deficiency assessment for the year 2007 to 2009. Untimely, the Coca-Cola appeal, no? Kasi yun yung findings ng commissioner, the IRS, inappeal nila kaagad-agad sa court. And then pagdating sa court, in-uphold ng court ang findings ng IRS. So, noon uphold na ng lower court, pumunta naman sila ngayon sa appeal, no? Sa tax appeal. Nag-appeal na naman sila. But in this case, if you try to look na tapos natin kasi na-desisyonan ito noong 2020, in-uphold ulit ng court yung findings ng IRS, no? At sa akin lang ha, sa may sariling opinion lang ako dito sa case, Bakit natalo dito ang Coca-Cola? Because nagkulang po siya ng documentation. At ano yung mga documentation na yun? Kagaya ng kanyang mga agreements, kanyang mga financial statements, kanyang mga reporting hindi po transparent. That's why pagdating na sa litigation, pagdating na sa trials, marami silang mga issues na hindi nila na masyadong na-explain because of lack of documentation. Or hindi natin alam no kung lack of documentation o sadyang hindi nila pinapakita yung mga documents, no? So in that case, nag-assess ang IRS ng more than $3 billion, no? So ito ngayong gabi, since this is the part 4, no? Gusto ko sanang tapusin sa inyo but then mahaba pa kasi gusto ko i-discuss talaga yung point, no? Yung mga issues na nangyari dito. Kasi ang sabi ko nga sa inyo, kahit na yung nag-aaral ako ng law, alam nyo, sa dami ng principle ng laws, sa dami ng cases na pinapamemorize sa iyo, sabi ko isang case lang, isang doctrine, isang case lang ang master mo. Maintindihan mo na bakit kailangan ang dami-dami mo pang memorizein. Kaya nga itong Coca-Cola, ayusin mo lang to i-comprehend mo itong case ng Coca-Cola, maintindihan mo na yung the whole principle ng transfer pricing. Hari, patayin mo yung kasi masakit sa mata. Diretso sa mata ko eh. So, okay lang na hinahawakan ko yung mic. No? Yung problema talaga sa sounds natin eh. Hindi talaga maganda yung sounds natin. Kaya nga, we have to improve it. Kasi, dyan tayo sa sound failure. Kahit na yung mga na-upload na ngayon. Ang sakit sa tenga. No? Ha?
Parang walang ginamit na mic, cellphone lang.
Oo nga, cellphone lang. Sakit sa tenga, no? So, we have to improve still our facilities, no? Okay. So, let's continue with our discussions on Coca-Cola versus the Commissioner of Internal Revenue. And then, ito na yung discussion natin tonight. Ito yung threshold considerations, no? Because in 1996, there was a closing agreement. No? So, ang Coca-Cola urges that the IRS acted arbitrarily by deviating from the 10-50-50 method. Kasi itong 10-50-50 method na to, ginamit nila to noong 1996 and prior years, no? Agreement na nila to. But noong 1997 na onwards, ayaw na ng IRS na gamitin. Why? Because there are deviation, there are changes. So, more or less, na-justify naman ng Commissioner of Internal Revenue na itong 10-50-50 method is no longer applicable because may mga changes na rin na nangyari sa Coca-Cola. No? Okay. So, the parties had agreed when executing the closing agreement in 1996. No? Kasi, ang sabi ng petitioner, yung IRS daw, hindi na niya sinunod yung 10-50-50 na rule. No? The Commissioner discretion to reallocate income under Section 482 is limited only by the arm's length standard. But the Commissioner may voluntarily limit his discretion in certain ways by entering into an advance pricing agreement. Kaya nga yung sa ibang countries depende sa orientation. Pero I know mga Japanese companies talagang mahilig silang mag-apply ng advance pricing agreement, no? Okay. C. Yaton Corporation versus Commissioner 140 TC 410-413 2013. He may also restrict his discretion by executing a closing agreement under Section 721. In 1996, the parties settled a transfer pricing dispute involving petitioners 1987 to 1985 tax years and embodied the terms of that settlement in a closing agreement. Yun na nga po yung 10-50-50 rule. Paano gumagana yung 10-50-50 rule? 10% of the profit will be retained by the brands or by the subsidiaries, and then yung sobra na profit will be divided 50-50 or 50% for the parent company and then 50% for the uh, butlers, no? In this case. Okay. Closing agreements are construed according to the intent of the parties when executing the agreement, and their intent will be inferred from the four corners of the document unless it is ambiguous, no? So under section 7121, a court may not include as part of the agreement matters other than matters specifically agreed upon and mentioned in the closing agreement. Okay. This in the case of Analog Devices Inc. versus Commissioner 147TC 429445 2016. Quoting Signs versus Commissioner 90TC 753766 1988. The recitals to the 1990s closing agreement stated that number one, petitioners owned intangible property that is used by supply points in connection with manufacture and marketing of concentrates. No? So may mga intangible property ang Coca-Cola noong 1996. Number two, a dispute arose regarding the allocation of product royalty income between supply points and petitioner. Actually, ito po yung issue sa transfer pricing. Yung allocation ng product royalty income from supply points and the petitioner. Petitioner, yung Coca-Cola, no? The parties have agreed on a method for computing arm's length amount of the product royalties. The body of the agreement details the 10-50-50 method as the agreed formula for determining product royalties for tax years 1987-1985. So, yan ang sinasabi ng Coke. Kasi for the year 1987-1995, ilang taon yan? 5 plus 3, 8 years. Pumayag ang IRS na gamitin nila yung 10-50-50 rule, no? And then, pagdating na ng case na under dispute, yung 2007 to 2009, hindi na pumapayag ang IRS. The short and the complete answer to petitioner's argument is that the closing agreement says nothing whatever about the transfer pricing methodology that was applied for years after 1995. Parties to a closing agreement may and sometimes do bind themselves to particular tax treatments for specified future years. For its part, petitioner may have desired the certainty that would arise from indefinite future application of the 10-50-50 method, but there is no evidence in the document that IRS shared that desire or agreed to implement it, no? Yung 10-50-50 na rule. Petitioner urges that the closing agreement was predicated on certain factual underpinnings, including a recognition by the IRS that the supply points were responsible for generating demand and were entitled to share in the resulting profits related to the company's intangibles. These factual underpinnings, petitioner says, are binding on the commissioner unless he can show some material change in underlying fact. Ilan na yung shoutout natin?
May 6 viewers, madam.
Okay. Wala pang shoutout?
Wala pa.
Sige. The argument is unpersuasive for at least two reasons. First, so ito hindi daw persuasive yung argument, no? Excuse me. Kuha mo ako ng tubig na mainit. Okay. So first, we do not discern in the closing agreement the factual underpinnings that petitioner seeks to extract from it, no? So the parties executed the closing agreement to settle a dispute. Parties agree to settlements for all sorts of reasons to avoid the hazard of litigation, to minimize litigation costs, or to seek other fees to fry. Imagine that. May sinasabi siya. There is nothing within the four corners of the closing agreement to suggest that Commissioner regarded the 10-50-50 method as the platonic ideal of arm's length pricing for petitioner and its supply points. No? The 10-50-50 method was simply a formula to which the parties agreed in settling the dispute between them at that moment. The only mention of arm's length in the closing agreement appears in a preliminary recital which is not binding on the parties. So Analog Devices Inc. 147TC at 446. See also Revenue Proclamation 68-16, Section 6.053, 1968-1, CB 770 and 779. Okay. Okay lang yung sound na hinawakan ko?
Apo.
Second, even if we could confidently extract any factual underpinnings from the closing agreement, there is no evidence that the parties intended them to be binding for future years. So petitioner urges that ordinary preclusion doctrines prevent parties from revisiting a settlement agreement, factual underpinning in later litigation when the parties intend their agreement to have that preclusive effect. But in so contending, petitioner assumes what it needs to prove that the parties in 1996 intended to address the appropriate transfer pricing methodology for years after 1995 and embodied that intent in the closing agreement. Arizona versus California, 530 U.S. 392414 2000. Noting that settlements ordinarily occasion no issue preclusion unless it is clear that the parties intend their agreement to have such an effect. Supplemented by 531 U.S. 1, 2000. Petitioner notes that the closing agreement was intended to have some prospective effect because it granted the company penalty protection for future years, providing for taxable years after 1995 to the extent that the taxpayer applies the 10-50-50 method to determine the amount of its reported product, royalty income with respect to existing or any future supply points, the taxpayer shall be considered to have met the reasonable cost and good faith exception of Section 6664 and 66662. No? E3D. And shall not be subject to the accuracy settlement to the accuracy related party under Section 6662. No? So with respect to the portion of any underpayment that is attributable to an adjustment of such product royalty. Okay. Okay, so we think this provision hurts rather than helps petitioner. So sa Coca-Cola, the petition daw na to hurts the Coca-Cola. It shows that the parties knew how to make the closing agreement conclusive for future years when they wish to do so. Where the specificity and apparent comprehensiveness of an agreement enumeration of a category of things implies that things not enumerated are excluded. So we will apply the canon express onius est exclusio alterius, no? Expressio onius est exclusio alterius, no? So yung kung ano yung sinama, na sinama talaga siya, hindi siya in-exclude, no? So BMC Software Inc. versus Commissioner 780 3D 669-676 5th Circuit, no? 2015. Okay. Indeed, the agreement specifically recognizes the possibility that the IRS might make transfer pricing adjustment for years after 1995, no? Because it gives petitioner penalty protection with respect to the platform of any underpayment that is attributable to an adjustment of such product royalty. Okay, next. Petitioner seeks to frame this issue as if the IRS has pulled the rug out from under it. After executing the 1996 closing agreement, petitioner took steps to minimize its exposure to VAT and income tax in Europe and elsewhere. And it viewed the closing agreement as facilitating the shift of concentrate supply among foreign supply points to meet its business exigencies. No? So we have that. Excuse me. Hindi lang kasi malamig yung likod ko. Okay. Ano yung last ko?
Yan ma'am, sa page, ano tayo, page 98.
98? Ah, okay. Sige.
Karugtong.
So, here, no, yung petitioner So after executing the 1996 closing agreement, petitioner took steps to minimize its exposure to VAT. Ito na yung nangyari kasi 'di ba, may agreement siya with Coca-Cola nung hanggang noong 1995. Nung pagdating na ng 1996, wala na silang agreement, of course. Yung petitioner, which is the Coca-Cola, took steps to minimize its exposure to VAT, no? Parang binabaan na niya yung kanyang compliance with VAT and income tax in Europe and elsewhere. Anong ginawa niya? And it viewed the closing agreement as facilitating the shift of concentrate supply among foreign, no, supply points to meet its business exigencies. So, certain of these actions are unhelpful to its neutral submission in this case that the supply points owned immensely valuable old off-book intangible assets that justify the extraordinary high profits they enjoyed. No? So yun ang justification niya. In essence, petitioner argues that it relied to its detriment on a belief that the IRS would adhere to the 10-50-50 method indefinitely. Pwede ba yun, no? Akala daw ng Coca-Cola na indefinite na yung adherence ng IRS to the 10-50-50 method. But petitioner cannot stop the government on the basis of a promise that the government did not make. No? Sa bagay, hindi naman promise yun ng IRS sa kanya. And in fact, hanggang 1995 lang talaga ang agreement na yun. After that, wala na. Pero ini-invoke pa rin ni Coke na dapat enforce pa rin yung 10-50-50 method. No? Okay. So, the mere fact that the taxpayer may have obtained a windfall in prior years does not entitle it to like treatment for the taxable years here in the issue. No? Okay. Relevant parties and transactions. Ito na. So, tapos na tayo dun sa threshold ng agreement, no? Dun sa yung pinirma nila na hanggang, yung closing agreement nila hanggang 1995, no? So, relevant parties and transactions, the Section 482 regulations require that we determine the true taxable income of a controlled taxpayer. At ito na yung sinasabi natin sa inyo that the Section 482 of the IRS of the Internal Revenue Service is the same as Section 50 of the National Internal Revenue Code provision. No? Taxpayer means any person, organization, trade, or business whether or not subject to any internal revenue tax. A controlled taxpayer is defined as any one of two or more taxpayers owned or controlled directly or indirectly by the same interest and includes the taxpayer that owns or controlled to the other taxpayers. No? So, ito na yung definition. Kung sino ba yung relevant parties, no? So, sila yung controlled taxpayers na under control lang ng others in the group. In determining the true taxable income of a controlled taxpayer, we examine the controlled transactions to which the taxpayer was a party. A controlled transaction includes any transfer between members of a controlled group of any interest in or right to use any intangible property. However, such transaction is effected and whether or not the terms of such transaction are formally documented. Yun lang. Kasi po, sa ating transfer pricing ngayon na napag-uusapan dito, transfer pricing documentation is very, very important. That's why, sabi ng OECD, you invest in documentation. The Commissioner properly treated the supply points and the serve cost as distinct sets of controlled taxpayers. No? Tama nga naman. That engage in discrete sets of controlled transactions with TCC itself, a controlled taxpayer. No? So TCC's affiliates perform distinct economic functions. The supply points manufactured concentrate and the serve costs arranged local consumer marketing and liaison with borders. These affiliates were separate legal entities or branches of CFCs or controlled foreign corporations that were separate legal entities and were treated by petitioners as such. No? So each supply point and serve co executed with TCCC export or CCC as the counterparty, a separate agreement specifying its parties' rights and obligations. Dito ka naman magpatay-hari. na nangangagat sa paa. Diyan. Diyan, no? Diyan. Tapos pupunta yan sila doon. Hmm? 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 Okay. So, ano pong sinasabi natin tungkol sa relevant transactions? They are not prohibited, no? But they should adhere to the arm's length standards. At ano yung arm's length standard? Dapat kung magkano yung binibenta ng unrelated parties, dapat ganun din yung pagbenta ng related parties, no? Ito talaga, may maraming nangangagat. Okay. Nasa likod. Okay. So, dami pong lamok. Commercial. No, commercial. Kasi ano sila nasakit, no? So, in determining the true taxable income of a controlled taxpayer, we examine the controlled transactions to which the taxpayer was a party. A controlled transaction includes any transfer between members of a controlled group of any interest in or right to use any intangible property. No? However, such transaction is effected and whether or not the terms of such transaction are formally documented. Yun yung sabi ko na ikakatalo ng isang kaso kasi di sila sigurado kung may forms, no? And then kung formally documented ba. The commissioner properly treated the supply points and the serve costs as distinct set of controlled taxpayers, no? So anong treatment ng commissioner? Magkaiba yung serve ko, no? Tsaka yung supply points. Okay. TCCC's affiliates perform distinct economic functions. The supply points manufactured concentrate and the serve costs arrange local consumer marketing and liaison with butlers. These affiliates were separate legal entity or branches of CFS that were separate legal entities and were treated by petitioner as such. Each supply point and servco executed with TCC, export or CCCs as the counterparty. A separate agreement specifying its party rights and obligations. Determining that the supply points had paid insufficient compensation to petitioner for the rights to use petitioner's intangible property, the commissioner reallocated income to petitioner from the supply points or from the CFC of which there were branches. Okay. Ito na, ang dami niyang hindi ma-account na transactions, no? So, the commissioner determining that the serve cost transactions with petitioner generally priced on a cost-plus basis were conducted at arm's length. So, kasi yun lang naman talaga ang kailangan o ang gusto ng BAR o kaya ang hinahabol sa transfer pricing that the pricing of goods and services should be at arm's length, no? At ano yung arm's length na sinasabi natin? The independent transactions are the true transactions, no? Okay. Generally priced on a cost-plus basis, yun yung pricing nila ng services nila, were conducted at arm's length. So, arm's length na sila. Except where split invoicing occurred, therefore, he made no transfer pricing adjustment with respect to the serve cost. Pero, pagdating na sa split invoicing, I think yung split invoicing na yan ang isang factor din na talo sa case niya, ang Coca-Cola. Why? Kasi ang split invoicing, Instead na isa lang yung mag-issue ng resibo, dalawa sila at ini-split nila yung resibo. Yung isa pumupunta doon sa Chile, no? Yun yung tatlong place na nagkaroon ng adjustment. Okay. Petitioner does not dispute and could not plausibly dispute that the supply points were controlled taxpayer within the meaning of section 1.482-1-B-1. Oh, andyan talaga sila. Kaya nga eh, masakit eh. Okay. But petitioner argues that we focus more broadly on the activities of its foreign business units or the BUs. Petitioner economic experts commonly refer even more vaguely to the field, by which they mean an amalgamation of TCC's foreign affiliates in toto. They seek to frame the task before us as dividing income between headquarters and the field on the basis of the historical marketing spent by the field. No? So we reject these overtures because they ignore the separate taxable and legal entities involved. No? Kasi ang BIO, hindi naman siya talaga entity. No? Each BU had responsibility for the company's economic performance within a geographical market, which could consist of one or more countries. The BUs receive reports and data from management accounting units or the MAUs. And the BUs in turn reported to regional operating groups or OGs. The MAUs, BAUs, and OG were not legal entities. No? So ito na naman sila. Hindi sila legal entities. Rather, they identified lines of managerial reporting from smaller to larger geographical territories and ultimately to headquarters in Atlanta. Ano ba yung nandun sa headquarters ng Atlanta? Yun si the Coca-Cola company, which is the owner of all intangibles. No? During the years at issue, the Servcos employed all the OG relationship and about 90% of the 200 officers who made up BU or the business unit leadership. No? So to the extent petitioner suggests that we should treat the BUs as the relevant controlled taxpayers, we reject that suggestion. The BU were not legal entities and were not taxpayers. Essentially, they were boxes on an organizational chart groups of companies officials who formulated business plans and prepared financial reports for their territories. Then forward those documents up to the chain to Atlanta to review and approve. So, ganun yung proseso. Unlike the supply points and the serve cost, the BUs engage in no economic transaction that could be tested for compliance with arm's length norms. Petitioner's suggestion, moreover, entails both duplication and inconsistency. Yan. Petitioner would treat the serve cost as controlled taxpayer transacting with TCCCs at arm's length, while using the BUs as proxies or substitutes for the supply points. Langaw naman. Laki. But the BUs consisted almost entirely of personnel employed by the Servcos. Petitioner agrees that the Servcos were properly compensated on a cost-plus basis for their employees. For their employee services. Petitioner can simultaneously contend that the services of these employees justified supranormal returns for the supply points. No? So we cannot endorse an approach that would count the contributions of the serve cost employees twice, as well as treat their contributions as having vastly different values depending on the entity which they were deemed associated. Kasi pagdating po sa paggawa na natin ng transfer pricing analysis, lahat yan himay-himayin natin. That's why dito pa lang sa case, hinihimay-himay na natin para hindi tayo mahirapan pagdating sa Actual na. Oh? Okay, so ano naman po itong the best method rule, no? Patay kang bata ka. May ulam doon. Okay. But we will not conflate the serve cost with the supply points, attribute the activities of the serve cost employees to the supply points, or otherwise combine them for purposes of our transfer pricing analysis. No? So the best method rule, and the best method rule is also being applied here in the Philippines. Why? Because the best method rule, sabi nung RR2-2013 na transfer pricing guidelines, when choosing for the method, apply all the methods and then choose the one which is the best method. No? Okay. So the best method rule, section 482, authorizes the secretary to make allocations between or among the members of the control group if a controlled taxpayer has not reported its true taxable income. No? Excuse lang po kasi patuloy ko yung laman. Or among the members of the control group if a controlled taxpayer has not reported its true taxable income. Kinain na ng pusa.
Hindi, nabutang ko.
Ano
Pero
siya?
nalaglag na yung takip.
Yung sa akin?
Hindi, yung naka-plastic na.
Ano eh? Lipad sila. Sige. May lamok, may langaw, may pusa. Yun po yung mga commercial namin. No? Dito. Pero okay lang yun. Okay. So, just like in the Philippines, the best method rule is also being followed, no? Because we have our RR2-2013, the transfer pricing guidelines that says you have to, in making a transfer pricing analysis, you have to apply all the methods and then recommend the best method, no? So, kayo yung maghanap ng method na you think is the most applicable. No? So, in any event, petitioner has offered no alternative transfer pricing analysis using the business units as the controlled taxpayers. So, income tax regulations, the BUs were managerial lines of reporting that crossed the lines of the underlying legal entities. So, ang business units, hindi sila talaga entity, no? Hindi sila kinoconsider na legal entity. Multiply supply points often sold concentrate into the geographical territory for which a particular business units had reporting responsibility. So one or more servcos might provide services within that area. Petitioner reconfigure its operations group in 2008. No? So combining Eurasia and Africa and the scope of its business units reporting responsibility could likewise change at any time as petitioner saw it. So none of the petitioner experts attempted to construct transfer pricing analysis using these vague and uncertain parameters. No? Okay. A controlled taxpayer's true taxable income is the income that would be resulted had the controlled taxpayer dealt with the other method or members of the group at arm's length. No? In assessing the appropriateness of any allocation, the standard to be applied in every case is that of a taxpayer dealing at arm's length with an uncontrolled taxpayer. No? The Department of the Treasury and the courts have applied this arm's length standard for decades, no? Essex Broadcasters Inc. versus Commissioner, discussing the Revenue Act of 1938. The rules governing the choice of methodology for applying the arm's length standard have changed significantly over time. Yan na yung nangyayari sa US, no? So, nung na-promulgate yun in 1968, the Treasury set forth a fixed hierarchy method, no? We're now talking of the methods, ha? Transfer pricing method na to kasi our topic is the best method rule, no? And usually, pag kayo na yung transfer pricing analyst, hinire na kayo ng company, yung isa ito sa mga responsibility talaga ng transfer pricing analyst because yung ibang mga information, pwede na nilang i-delegate yun sa company. Pero pagdating na sa maghanap ka na at then mag-recommend ka na ng comparables, then it's for the transfer pricing analyst na. Okay. Treasury set forth a fixed hierarchy of methods, with the comparable and controlled price method being the most highly priced. Okay, yun yung CAP method. Kasi pagka available yung information, the comparable and controlled price method, best result, no? Yung nagbibigay siya ng best result. The other methods specified in the 1968 regulations in order of priority were the resale price method and the cost plus method, no? Paragraphs 3 and 4. These regulations authorize the use of other appropriate method or variations, the specified methods for determining an arm's length price. Strand Corporation, 1960 at 358. But use of an unspecified method was allowed only if none of the three specified methods of pricing can reasonably be applied under the facts and circumstances as they exist in a particular case. So in cases governed by the 1968 regulations, courts search assiduously for comparable uncontrolled sales, heeding the regulations' injunction that if such transactions existed, the CAP method must be utilized because it is the method likely to result in the most accurate estimate of an arm's length price. In 1985, Congress expressed concern that courts had sometimes strayed too far in this direction by approving use of the CAP method, even though there are significant differences in the volume and risks involved in other factors. So viewing this problem as troublesome where transfer of intangibles are concerned, Congress decided that a statutory modification to the intercompany pricing rules regarding transfer of intangibles was necessary. No? Kaya nga sa ibang bansa, very particular na talaga sila sa intangibles and they have come up with specific rules on intangibles. No? So the 1968 regulations had distinct rules for transfer of intangible property. The preferred method was still the CAP, no? Yun pa yung CAP. Bakit? Comparable uncontrolled price method. Bakit? Kasi pagka ang CAP ang ginamit mo, the price to price, yan yung nature and characteristic of goods and services, ma-present mo yung proper na information, parang yun yung pinaka magandang method na pwede mo i-compare, no? Kasi yung iba, estimate na lang. Dito sa price talagang actual siya, no? The three hierarchy was understood to apply for purposes of transfer pricing generally. So, mas specific talaga ang CAP, no? Okay. So, Congress accordingly amended Section 482 to require that in the case of any transfer or license of intangible property, the income with respect to such transfer or license shall be commensurate with the income attributable to the intangible. No? So, ano yun na sinasabi? Commensurate with the income attributable to the intangible. Pero na silang catch-all provision. no? Parang residual definition of intangible. Tax Reform Act of 1986, no? Ito yung publication L-99-514. The Congress recognized that this legislation left unresolved many difficult and important issues. Yan yung ginawa nila noong 1985, no? So it therefore directed the IRS to give careful consideration to whether the existing regulations could be modified in any respect. So parang kulang pa rin yung ginawa nila noong 1985. So the Congress response, no, sa Treasury 1994 promulgated new regulations under Section 482 that superseded 1968 regulations for transactions after their effective date, no? So income tax regulations, these regulations eliminated the hierarchical approach of the 1968 regulations and replaced it with the best method rule, no? So ano yung hierarchical method? So if there is a hierarchy, una na yung cap, sunod yung cost plus, sunod yung resale price, sunod-sunod siya. So hierarchy. Pinalitan yon at anong ginawa? The best method rule, no? The best method rule requires that the arm's length result of a controlled transaction must be determined under the method that, under the facts and circumstances, provides the most reliable measure of an arm's length result. Thus, there is no strict priority of methods, no? And no method will invariably be considered to be more reliable than others. So for controlled transfer of intangible property, the regulations require that the arm's length result be determined under one of four methods listed in Section 1-482-4-A. The four permissible methods are, sa US po ito so yung US is different from the OECD. Kasi ang OECD, 5 methods po sila, no? Pero sa way or sa methodology, hindi naman din po sila magkakalayo, no? So the comparable uncontrolled transaction method, which succeeded the CAP method of the 1968 regulations, the comparable profits method, no, the CPM, which the commissioner employed in this case, the profit split method, and an unspecified method, no? Ano yung unspecified? Pwede mong gamitin yung ibang method provided it is relevant to the case. Subject to constraint set forth in the regulation. Detailed rules for applying the CPM are set forth in Section 1.482-5 on income tax regulations. So the petitioner or the Coca-Cola in this case launches a threshold sally against respondent's methodology by urging that the CPM is inferior in some generic sense. No? CPM, ito yung comparable profits method. No? To other methods for pricing transfers of intangible property. So, hindi raw pwede yung CPM. No? So, for that proposition, petitioner relies chiefly on a statement in the Preamble to the 1994 final regulations where Treasury referred to the CPM as a method of last resort. No? So, TD 8552-1994.2 CB at 109. Petitioner's argument pays insufficient heed to the context in which that statement was made. No? So, the Preamble notes that given adequate data, methods that determine an arm's length price or the CAP method generally achieve a higher degree of comparability than the CPM. No? For that reason, results based on comparable uncontrolled transactions will be selected unless the data necessary to apply the CAT method are relatively incomplete or unreliable. In this regard, Treasury said that the CPM generally would be considered a method of last resort. No? So, comparable profit method daw is considered lastly among the methods. No? So, balikan ko lang po sa mga transfer pricing analyst natin. No? So, this is how you are going to choose the method. Dito, pinapakita po sa atin dito yung proseso on how we choose the method. No? And aside from that, sa mga gumagawa ng mga transfer pricing analysis report, just be careful, no? And then see to it that you analyze thorough analysis for the transfer pricing analysis report. Why? Because just like in this case of Coca-Cola, when the case already reaches the court, the one who prepares the transfer pricing analysis report will be summoned by the court to testify before the court, no, about his work na transfer pricing documentation. Kaya hindi lang madali, hari, yung mga gagawin natin na transfer pricing analysis report. Hindi yan basta-basta madali. Why? Kasi isusumon ka pa ng korte. Bakit? How did you arrive on this method? No? Bakit ito yung pinili mo? Kasi magre-recommend ka ng best method rule. No? So you will be summoned to the court and then talagang panindigan mo yung ginawa mo. No? Treasury reference to the CPM as a method of last resort is predicated on the assumption that adequate data are available to apply the CUT method, comparable uncontrolled transaction method. So the 1968 regulations had directed the use of the CUT method so long as there existed uncontrolled transactions involving the same or similar intangible property under the same or similar circumstances. The current regulations, by contrast, indicate that the CUT method has an especially high degree of reliability only. If an uncontrolled transaction involves the transfer of the same intangible under the same or substantially the same circumstances as the controlled transaction. Petitioner has identified no pricing data for transactions with unrelated parties that involve the transfer of the same intangible, no? Viz. The trademarks, brand names, patents, logos, secret formulas, and proprietary manufacturing processes. Treasury noted that a method based on gross margin, the resale price method, may likewise offer a high degree of reliability, again, assuming the availability of adequate data. No? So, neither party suggests that a method based on gross margin is the best method in this case. So, kayo na mismo, no, ang mag-recommend at saka mamili what is the most applicable method in the case. No? The circumstances that cause Treasury to refer to the CPM or comparable profit method as a method of last resort do not exist here. No? So, example 4, income tax regulations, treating the CPM as the best method for determining an arm's length royalty for the transfer of intangibles to a foreign affiliate that performs routine manufacturing functions. So, in short, as the preamble elsewhere explained, the final regulations make it clear that the CPM is subject to the same conditions as any other method. There is no strict priority of methods, and no method will invariably be considered to be more reliable than others. No? So, income tax regulations, the reliability of any particular method depends on the facts and circumstances of its case, especially on the quality of data and assumptions used in the analysis and the degree of comparability between the controlled transaction or taxpayer and any uncontrolled comparables. Kaya ito yung unique sa mga transfer pricing cases kasi hindi mo masabi na ito na yung precedent, ito na yung nangyari noon, so ito applicable na din to sa akin. Why? Kasi sa transfer pricing case po, factual, no? Factual. Ano ba talaga ang nangyari? Hindi yung similar, no? Factual. Okay, so respondent's butler, CPM. So, sino yung respondent dito? Yung butler ng Coca-Cola. Each party relies on expert testimony to establish the arm's length price for the transfer of positions intangibles. Expert testimony is admissible where it assists the court to understand the evidence or to determine a fact in issue. Okay. The court has broad discretion to evaluate the cogency of an expert analysis. Excuse me. We are not bound by any particular expert's opinion. Kaya nga, opinion lang yan eh. Ang court, kukuha siya ng expert advisor niya. Ang taxpayer, meron ding expert advisor. It's part of the due process. So we are not bound in any particular expert's opinion, and we will reject expert testimony to the extent it is contrary to the judgment we form on the basis of our understanding of the record as a whole. Excuse me. In support of his position, the Commissioner relies chiefly on the expert report prepared by Dr. Nyolon. So he determined that the supply points other than the Egyptian supply point enjoyed levels of profitability and justified by the economic functions they perform. They engaged almost exclusively in manufacturing, and petitioners, experts, agreed that this was routine activity that could be benchmarked to the activities of contract manufacturers. Two petitioners' experts, Dr. Scragg and Uni, applied an 8.5% markup on cost to determine an appropriate arm's length return for the supply points concentrate manufacturing functions. Okay. So, sino itong tatlo na to? The Brazilian, Chilean, and the Egyptian supply points employed personnel who engaged in other activities, including marketing, sales, and finance, to the extent that the supply points performed non-manufacturing activities. So they discharge functions similar to those performed by ServCos employees. The ServCos were compensated for their employee services on a cost-plus basis with an average markup of 6% to 7%. Okay, so petitioner does not question the arm's length character of the ServCos compensation. The arm's length compensation for the totality of the services performed by the supply points would thus seem to be somewhere between 6% and 8.5%. But the profits the supply points enjoyed vastly exceeded the range. So one needs to more than a back of the envelope calculation to make this clear. So yung 7 supply points for 2007 to 2009, ito yung laman ng assessment. Reported total revenues of roughly 31.71 billion, or an average of 10.57 billion annually. So they reported total gross profits for those years of 25.44 billion. I can just imagine. Or an average of 8.48 billion annually. After offsetting cost of goods sold and other cost of about 2 billion annually. So 2 billion annually na naman yung cost niya. With a few exceptions, chiefly for the Egyptian supply point, their gross profit margins range between 75 and 90% naman. The 7 supply points for 2007 to 2009 requested average business expenses consisting mostly of the expenses incurred by the ServCos and assigned to the supply points, So yun yung nangyayari, of 4.63 billion annually. According to those expenses to their COGS And other courts, we derive average total of 6.72 billion per year. No? 4.63 minus 2.09 billion. Their average annual revenues has exceeded their average annual cost by 3.85 billion. They thus enjoyed an average a markup on cost of about 57%. No? That return is almost 7 times higher than the 8.5% return that represents the arm's length value of the manufacturing activities they perform. A test conducted by Dr. Newton confirms that the supply points net profit levels were economically inexplicable. He compared their profitability to that of the companies classified by Standard and Poor as manufacturers of food, beverages, and related products. After eliminating smaller entities and those with significant data, he examined a universe of 996 companies that included in the company. No? So, the Pepsi-Cola company, ito yung ano niya Nestle, major brewing companies, butlers, and virtually every other major food or beverage manufacturer worldwide. So Dr. Newton compared the average ROAS for these 996 companies to the supply points average ROA for 2007 and 2009. So he plotted his results on a histogram or horizontal axis shows the company's ROA, and those vertical axis shows the number of companies that fall into each 5% increment of ROAS. No? So ito na yung analysis po na ginawa nila. No? So, ang ginamit ni Dr. Newton dito is return on assets, no? Paano mo i-complete yung return on assets, no? So, compare the average for 996 companies to supply points average ROAS for 2007-2009. So, anong ginawa ni Dr. Newton? He plotted his result on a histogram of horizontal axis. Shows the company's ROAS, and whose vertical axis shows the number of companies that fall into its 5% increments, no, of ROA or return on assets. Okay? So, what is this profitability of supply points versus global industry comparison group? So, ito yung supply doon, no? O ito yung data nung ginawa ng experts para kay supply points, no? So, yung data dito is up to 215%, no? 215%. Okay. Okay. The arm's length compensation for the totality of the services performed by the supply points would thus seem to be somewhere between 6% and 8.5% above their cost. Okay. So the Coke in this case has the 7 supply points for 2007 to 2009. Ito yung under assessment, no? Dito nag-assess ang IRS. They reported total revenues of 31.71 billion or an average of 10.57 billion annually. So they reported total gross profit for those years of 25.44 billion or an average of 8.48 billion annually after offering cost of goods sold and other costs of about 2 billion annually. No? So with a few exceptions, chiefly for the Egyptian supply point, their gross profit margin ranges between 75% and 90% each year. Ang taas, no? Sobrang taas. The 7 supply points for 2007 to 2009 reported average business expenses consisting mostly of expenses incurred by the server cost and assigned to the supply points. So, magkano yun? 4.63 billion annually. Okay. So, adding those expenses to the cost of goods sold and other costs, we derive average total of 6.72 billion per year. So, 4.63 billion plus 2.09 billion. Their average annual revenues thus exceeded their average annual cost by 3.85 billion. No? So 10.57 minus 6.72 billion. They thus enjoyed an average, a markup on cost of about 57%. The return is almost 7 times higher than the 8.5% return that represent the arm's length value of the manufacturing activities they perform. No? So a test conducted by Dr. Nyolon confirms that the supply points net profit levels were economically inexplicable. He compared their profitability to that of companies classified by Standard & Poor's manufacturer of food, beverages, and related products. After eliminating smaller entities and to those with sufficient data, he examined a universe of 996 companies that included the Pepsi-Cola company, Nestle, major brewing companies, butlers, and virtually every other major food or beverage manufacturer worldwide. No? So Dr. Nyolon compared the average ROAS for these 996 companies to the supply points average ROAS for 2007 to 2009. He plotted his result of a histogram whose horizontal axis showed the company's ROAS and whose vertical axis shows the number of companies that fall into each 5% increment of ROAS. No? Yan yung return on assets. Okay. Yan yung analysis po nila ng return on assets 2007-2009. Bakit return on assets? Yan po yung ginamit ng kanilang consultant on transfer pricing. No? Okay. So as this figure shows, the company as a whole with an ROA of 55% was highly profitable. No? Kasi ang taas na ng return on assets mo, 55. So you're highly profitable. It performed 968 or 97% of the 1996 tested companies. No? So, but the supply points have much higher ROAS than the company, reflecting the shift of intercompany profits to them. So, the Irish, Brazilian, Chilean, and Costa Rican supply points with average ROAS of 215%, 182%, 149, and 143 respectively. No? So they had ROAS higher than any of the 1996 company in the comparison group, literally off the high of the bell curve. No? The Swansea and Mexican supply points with ROAS of 129% and 94% respectively. So had ROA higher than 99% of the companies in the comparison group. So this data prompt two obvious questions. Why are the supply points engaged as they are in economic contract manufacturing? So the most profitable food and beverage companies in the world. Add why does their profitability dwarf that of TCCC? No? So it's owns the intangibles upon with the company's profitability issues. Concluding that these results did not clearly reflect income, the commissioner allocated income between the controlled taxpayers, between the supply points and petitioner employing CPM. No? Sa kanila, ang CPM is comparable profit method. No? So that treated independent Coca-Cola bottlers as comparable parties. The CPM is a specified method for determining the arm's length consideration for the transfer of intangible. So under the CPM, the determination of the arm's length result is based on the amount of operating profit that a controlled taxpayer, the tested party, would earn if its profit level indicator were equal to that of an uncontrolled companies. No? So section 1.482-5-B1. Non-controlled companies is an unrelated taxpayer that engages in similar business activities under similar circumstances. So reported operating profits in excess of the benchmark profit level indicator are allowed to the other controlled party. So, yun na po yung nangyayari sa kanila, no? So, respondent, Dr. Newlon, employed a comparable profit method, no? Binensmark niya yung supply points profits to the profits earned by independent Coca-Cola bottlers, no? So, actually, ang ginamit niya dito, internal comparables eh. So, in the initial report that he prepared for the IRS, Dr. Newlon selected 18 independent Coca-Cola bottlers, no? So, independent. Headquartered in 10 different countries that he had qualified auditors' opinions for 2007 to 2009. So, in the expert witness report that he prepared for trial, he expanded his list to 24 bottlers. No? Kasi iba yung bottlers, iba yung supply point. So he concluded that the best profit level indicator was a ROA, or the return on assets, which is ginawa niya dito. No? So ROA is the ratio of operating profit to operating assets. No? The regulations list this ratio, also called the rate of return on capital employed, as specified PLI for comparing operating profits of the tested party and the uncontrolled comparables. No? So, ano sabi ng court dito? Ito na po yung yung decision ng court. Ano sabi niya? We conclude that the commissioner did not abuse his discretion by using the bottler ROA to reallocate income between petitioner and supply points. No? First, a CPM analysis was appropriate given the nature of the assets owned and the activities performed by the controlled taxpayer. No? Second, the commissioner selected appropriate comparable parties. No? The commissioner, number 3, computed and applied this ROA using reliable data, assumptions, and adjustments. We find that the butlers in many respects enjoyed an economic position superior to that of the supply points, which would justify for the butlers a higher relative return. No? So, Dr. Newlon's choice of methodology was thus conservative. So, pinanigan po ng korte. Reasonableness of the CPM analysis. No? Anong oras na? Hari?
1 hour 18 minutes. May shoutout po.
Sino? Sige. Shout.
Si Ma'am Lilia
Lilia.
Fernando.
Sus, nandyan din pala siya.
Yung isa ma'am, si Ma'am Lilian.
Yaw.
Lilia, tsaka Lilian.
Okay, yan sila, no? Mga masisipag, no? Okay. Alam nyo, napakaganda nitong case ng Coca-Cola, kaya ito yung pinili ko eh. Bakit? Ang dami mong matutunan sa procedure, sa procedural, no? Kung anong ginawa ng taxpayer, anong ginawa ng IRS dito, no? So, tuloy lang po tayo. Walang, question?
Wala pa po.
Okay. For those na gumagawa ng transfer pricing analysis report, you can also refer to this case. Paano gumawa talaga yung very specific na report. No? Kasi nandito rin siya. Ito na yung pag naghanap ka na ng methodology na i-apply mo. No? Okay. So let's now go to the reasonableness of the CPM or the comparable profit method analysis. No? So it has been shown that the choice of transfer pricing method is largely driven by the question, who in the group owns the valuable non-routine intangibles? Oh, so sino ang nagmamay-ari ng intangibles among the group, no? Kasi minsan pinapangalan yan sa parent company, minsan to add any other subsidiary companies, no? Intangible assets, especially unique intangibles of the kind involved here, tend to defray easy valuation for at least 3 reasons. First, they derive their high value from their ability to exclude comparable external transactions. So, exclude the external transactions, no? Okay. Comparable external transactions involve high value intangibles may occasionally exist, no? See Amazon.com Inc. 148 TC at 167. Finding a reliable cut where the taxpayer built for an unrelated party a website that included all the features of the taxpayer's own website and enabled the other party to sell its retail product online. But external transactions involving a company's crown jewels are quite rare. Okay. Ang pinag-usapan po dito sa Coca-Cola na to yung intangible niya, no? Ano yung intangibles na pinag-usapan niya dito? Ito yung siya yung owner ng logo, brand, no, business name ng Coca-Cola, no? So dapat siya din yung, since siya yung may-ari, dapat mas malaki yung kita niya doon sa mga butlers or subsidiaries niya, no? So second, the value of such intangibles is not easily delimited from the taxpayer's complementary business assets. Thirdly, the profit potential of such intangible is not reliably tethered to any cost or other input. So value in the eye of the beholder, the valuation of intangibles for transfer pricing purposes. Where controlled transactions implicate high-value intangibles, therefore, the most reliable transfer pricing method is often the one that avoids any direct valuations of those intangibles. Oh? The choice among indirect method typically depends on who owns the intangibles. Kasi depende daw yan kung sino nagmay-ari ng intangibles. No? So the profit split method will often be appropriate where both controlled taxpayers contribute significant intangible property. No? Kung pareho silang controlled taxpayer, tapos, yung sabi dito, meron silang pareho ng contribution sa intangible property. No? So by contrast, the CPM will often be preferred where only one of two entities contributes meaningful intangible property. No? The case is particularly susceptible to a CPM analysis because petitioner owned virtually all the intangible assets needed to produce and sell the company's beverages. Petitioner was the registered owner of virtually all trademarks covering the Coca-Cola, Fanta, and Sprite brands, and of the most valuable trademarks covering the company's other products. No? So petitioner was the registered owner of nearly all of the company patents, including patents covering aesthetic designs, packaging materials, beverage ingredients, and production processes. No? So petitioner owned all right to the company's secret formula and proprietary manufacturing protocols. No? So petitioner owned all intangibles property resulting from the company's R&D, research and development, considering new products, ingredients, and packaging. The petitioner was the counterparty to all the Butler agreements, giving it ultimate control over the distribution system for the company's uh, beverages. Most Serco agreement executed after 2003 explicitly provided that any marketing concepts developed by third-party vendors are the property of export. No? So, export isang subsidiaries din ito ng Coke. Thus, cementing petitioners' ownership of marketing intangibles subsequently developed outside the United States. No? So, outside the United States na siya nagde-develop ng intangibles. The supply points, by contrast, owned few, if any, valuable intangibles. Their agreements with petitioner explicitly acknowledge that TCC owned the company's trademark, giving the supply points only a limited right to use petitioner's IP in connection with manufacturing and distributing concentrate. For supply points, including the Iris supply point, showed zero trademark or other intangible assets on their balance sheets. None of the other supply points develop a significant intangible in-house. Only the Brazilian supply points showed meaningful IP, but its IP of 190 million attributable largely to locally owned beverage brands. No? So, Butler franchise rights and goodwill represented just 11% of its total assets. No? The supply points agreements with petitioner granted them rights to produce and self-concentrate. Petitioner refers to these rights as franchise rights, but these agreements were terminable by petitioner at will. So no supply point enjoyed any form of territorial exclusivity. So hindi na sila exclusive no na itong lugar na to hindi po pwede pumasok ng iba. And no supply point was granted any right unless or implied to guarantee production of concentrate. No? The impermanence of their rights was demonstrated in practice from 1986 through 2009. TCC closed or shifted production away from 18 supply points, but no supply point received any compensation for their loss of production and income. We find no factual support for the assertion that the supply points own valuable intangible assets in the form of franchise rights. Diyan sa may flag. So the Coca-Cola system is an extremely sophisticated and complex operation. Bakit extremely sophisticated and complex operation? No? Sa dami ng mga units niya at subsidiaries. But nearly all of its complexity is external to the supply points. No? So the engaged in routine manufacturing, mixing ingredients specified by petitioner according to manufacturing protocols supplied by petitioner. In essence, they were wholly owned contract manufacturers. The CPM is ideally suited to this scenario. The CPM evaluates the profitability only of the tested party. Here, the supply points, and it can thus determine an arm's length profit range for the supply points without attempting a direct valuation of the company's hard-to-value intangibles. No? So, hard-to-value intangibles. There is a possible wrinkle to the CPM applications where controlled transactions involve multiple controlled taxpayers apart from the tested party. In that event, determining an arm's length profit range for the tested party does not end the inquiry for the remaining profit, but then be divided between the other entities. So the further step is not difficult here, putting aside the split involving allocations, petitioners and respondent agree that the served cost the other group of controlled taxpayers receive arm's length compensation for the functions they perform. Thus, once the CPM determines an arm's length profit level for the supply points, their residual income is necessarily reallocated to petitioner, the owner of the valuable intangibles. The petitioner or the Coca-Cola here identified no pricing data for transactions with unrelated parties that involve the transfer of the same intangible. The trademarks, brands, names, logos, patents, secret formula, and proprietary manufacturing processes used to produce Coca-Cola, Fanta, Sprite, and the company's other branded beverages. So the reliability of any cut method is thus considerably reduced. No? So once it has been rolled out, the CPM is preferable in principle to the profit split method because petitioner owns virtually all of the relevant intangibles. No? Okay. Okay. So, anong oras na natin? 1 hour?
32 minutes.
1 hour?
32.
32 minutes. So, 28 minutes pa. Walang shout-out?
Wala pa po.
Yung sa tax training, marami ka ng ano doon? Sa, yung sa messenger ko. Okay. Okay. So, balik tayo sa supply points, no? Kasi ito talaga yung issue dito. No? So, ito yung mga critic na nagbabatuhan na ng reason yung court at saka yung taxpayer dito, no? So, the supply points agreements with petitioner granted them rights to produce and sell concentrate, and petitioner refers to these rights as franchise rights. No? But these agreements were terminable by petitioner at will. No supply point enjoyed any form of territorial exclusivity, and no supply point was granted any right, express or implied, to guaranteed production of concentrate. No? So, walang binigyan ng rights, no? So the impermanence of their rights was demonstrated in practice from 1986 through 2009, no? So TCCC closed or shift production away from 18 supply points, no? But no supply point received any compensation for this loss of production and income. So we find no factual support for the assertion of the supply points owned valuable intangible assets in the form of franchise rights. So the Coca-Cola in this case, extremely sophisticated and complex operation, but nearly all of its complicity is external to the supply points. So they engage in routine manufacturing, mixing ingredients specified by petitioner according to manufacturing protocols supplied by petitioner. No? In essence, they were wholly owned contract manufacturers. No? So the CPM is ideally suited to the scenario. The CPM evaluates the profitability of the tested party, here the supply points, and it can thus determine an arm's length profit range for the supply points without attempting a direct valuation of the company's hard-to-value intangible assets. No? So there is a possible wrinkle to the CPM application where controlled transactions involve multiple controlled taxpayers apart from the tested party. So in that event, determining an arm's length profit range for the tested party does not end. The inquiry for the remaining profit must then be divided between the other entities, no? So this further step is not difficult here. Putting aside the split invoicing allocations, na para sa akin, isang nagpatalo din sa Coca-Cola dito is yung kanyang split invoicing, no? Okay, so petitioner and respondent agree that the served cost, the other group of controlled taxpayers received arm's length compensation for the function they performed. Thus, once the CPM determines an arm's length profit level for the supply chain, for the supply points, the residual income is necessarily reallocated to petitioner, the owner of the valuable intangibles, no? So, sino yung owner dito ng valuable intangibles? Si TCCC or the Coca-Cola company. Okay. Petitioner has identified no pricing data for transaction with unrelated parties that involve the transfer of the same intangible. No? So for instance, the trademarks, brand names, logos, patents, secret formulas, and proprietary manufacturing process used to produce Coca-Cola, Fanta, Sprite, and the company, other branded beverages. No? So itong section 1.48-4C2 income tax regulations. The reliability of any cut method is thus considered reduced here. Once it has been ruled out, the CPM is preferable in principle to the profit split. Why? Because petitioner owns virtually all of the relevant intangibles. So, example. Okay. Yung next natin na topic is the selection of butlers as comparable parties. Itong mga butlers na to, they are also hindi naman subsidiaries ng Coca-Cola, but they are independent butlers, no? Sige. Sila yung pipiliin para maging comparables, no? Comparable parties. So our conclusion that the controlled activity was highly susceptible to a CPM analysis does not suffice to show that the commissioner's CPM is the best method for ascertaining an arm's length price. No? So, section 1.482-1C1. So, income tax regulations. We must determine next whether the independent Coca-Cola bottlers that the IRS selected are reasonably treated as comparable to the supply points for this purpose. The determination of the degree of comparability between the tested party and the uncontrolled taxpayer depends upon all the relevant facts and circumstances. No? So like other transfer pricing methods, the CPM requires consideration of the general comparability factors set forth in section 1.482-1D, income tax regulations. These factors include functions performed, contractual terms, risk, economic conditions, property employed or transferred, and others. No? Each of these factors must be considered in determining the degree of comparability between taxpayers and the extent to which comparability adjustment may be necessary. No? So, maganda itong requirements dito sa provisions na to. So the CPM is scaled to operating profit, which represents a return for the investment of resources and assumption of risk. No? So for this reason, comparability under this method is particularly dependent on resources employed and risk assumed. No? Moreover, because resources and risk assumed are directly related to functions performed, an analysis of functions performed is important in determining the degree of comparability between the tested party and the uncontrolled taxpayer. So other relevant factors include the parties' respective lines of business, the product or service markets involved, the assets composition employed, including the nature and quantity of tangible assets, intangible assets, and working capital, the size and scope of operations and the stage in business or product cycle. So we agree with the Commissioner's conclusions that the independent Coca-Cola bottlers serve as appropriate comparable parties for purposes of CPM and ROA analysis. The bottlers are comparable to the supply points because they operated in the same industry, faced similar economic risks, had similar but more favorable contractual, an economic relationship with petitioner employed in the same manner. So many of the same intangible assets, petitioner's brands, name, trademarks, and logos, and ultimately shared for the same income stream from sales of petitioner or beverages. No? So, anong oras na, Hari?
1 hour and 42.
So, 18 minutes pa, no? Tapusin pa natin itong, kaya pa. Okay, so the functions performed by the butlers resemble those performed by the supply points. No? Parang resemble lang. Pero yung butlers, sila talaga yung nagmamanufacture. Except that the butlers perform those functions at a greater scale. No? So, both sets of companies engage in the manufacture and distribution of products in the non-alcoholic, yan ang sinasabi dito nitong NRARTD, no? Non-alcoholic, kalimutan ko na yung ibang beverage business, no? So both sets of companies thus engage in the same line of business and ultimately serve the same product, no? So the manufacturing activity in both cases was routine, consisting largely of mixing ingredients, no? So nagmi-mix ng ingredients according to detailed protocol supplied by petitioner. No? So example, concluding that the ratio of operating profit to operating asset is an appropriate profit level indicator where the tested party engages in relatively routine manufacturing activities. No? So quality control was important to both sets of companies, and they engaged in comparable forms of quality control at the plant level, subject to standards prescribed and inspection conducted by petitioner. The butler's distribution functions was more complex and benefited from greater economies of scale. Ano yung sinasabi natin dito na economies of scale? Mas nakakatipid, no? So the butlers were responsible for securing, retaining, and distributing to thousands of retail customers, whereas the supply points distributed to a relatively small number of butlers that had pre-existing contracts with petitioner. So in that respect, the butlers would be deserving of a higher ROA than the supply points. So Dr. Newland's selection of the butlers as comparable parties was to that degree conservative. Okay. So ito yung footnote dito, no? Petitioner does not appear to dispute the application of the ROA for the supply points manufacturing activity. Indeed, it agrees that a ROA is most reliable when operating assets play a significant role in generating operating income of the tested party. But particular petitioner urges that the butlers are non-comfortable to the supply points because the latter supposedly possessed immediately valuable off-book assets in the form of marketing intangibles. No? So we address the contention. Okay. So with respect to contractual terms, ito na yung contractual terms which is the very important also na comparability factors. No? So with respect to contractual terms, Dr. Newland's selection of the butlers as comparables was appropriate, no? But conservative. Formally speaking, the bodies and the supply points operated under similar contracts with petitioner. Both sets of contracts recognized that TCC owned the trademarks and the IP needed to produce the beverages. No? So the butlers and the supply points enjoyed limited and essentially equivalent rights to use petitioners' IP in carrying out their manufacturing and distribution functions. No? And TCC received the rights to terminate both types of agreement on no more than a few months' notice. No? So kailan dapat na-receive yung notice kung deliver lang? No? So, practically speaking, however, butlers enjoyed more favorable contract terms. The supply points generally had very short-term contracts that petitioner could and frequently did terminate at will. The contracts gave the supply points no territorial exclusivity and other supply points routinely sold into their home markets. Their contracts afford them no guarantee productions. The reflects dozens of production shifts among supply points in the decades after 1980. The TCC closed or shifted production away from at least 18 years. Between 1986 and 2009, the supply points had no say in this, with all production shifts being dictated by CFS in Atlanta. Sino itong CFS? Subsidiary pa rin ng Coke, no? So the largest butlers, which Dr. Newland included in this sample, had 10-year contracts with petitioner. Okay, so mayroon na palang siyang contracts, no? So although TCC reserved the rights to terminate their contracts on short notice, the mutual dependence between the company and its butlers ensured that butler agreements were almost always renewed. No? As CCE, one of the top 3 butlers, stated in its public findings, we believe that our interdependent relationship with TCC and the substantial cost and disruption to that company that would be caused by non-renewals ensure that these agreements will continue to be renewed. For this reason, most major butlers, including CCE, Hellenic, and Coca-Cola FEMSA, assigned to their bottling contracts an indefinite useful life for accounting and financial statement purposes. No? So the butler's contracts with petitioner also afforded them a high degree of territorial exclusivity. TCC's agreements with most butlers included a geographically defined market in which the butler was granted exclusive rights to produce and sell beverages. For legal reason, explicit exclusivity clauses were generally absent from the European butler agreements, but in practice, butlers respected each other's national territories and rarely attempted to sell into them. No? So kahit wala sa kontrata, hindi nag-overlap. Because the butlers in practice enjoyed more favorable contract terms both as to duration and exclusivity, the butlers would be deserving of a higher ROA or return on assets than the supply points. So in this respect, Dr. Newland's selection of the butlers as comparables was again conservative. No? In many respects, the butlers and the supply points faced comparable economic conditions. Okay. So both sets of companies engaged in the non-alcoholic to na mga beverages, no? Business with their revenues ultimately dependent on retail sale of the company's beverages. They thus faced similar risk from economic cycles and the ebb and flow of consumer demand. The butler selected by Dr. Newland, like the supply points, did business on multiple continents, and Dr. Newland segmented the butlers and supply points into corresponding geographic regions, no? Thus minimizing the risk of non-comparability owing to uniquely local market factors. Okay. So in determining comparability, we must consider in particular any economic conditions that could affect the prices that would be charged or paid or the profit that would be earned by the tested party and the uncontrolled comparable. So in this regard, we consider, among other things, the extent of competition in its market and the alternatives realistically available to the buyer and seller. No? The supply points sold concentrate to preordained buyers in a global market where competition was robust. Butlers contracted with TCCC and agree to purchase concentrate from whichever supply point TCC dictated. No? So most supply points had unused production capacity. There were no substantial barriers to prevent TCC or others from quickly building more capacity, and none of the supply points enjoyed any significant local advantage. No? So in other words, ito na yung procedure na sinundan ng Coke, no? So in other words, the supply points were easily replaceable and regularly were replaced, no? At relatively low cost to petitioner. Indeed, when petitioner shifted concentrate production from one supply point to another without building a new manufacturing plant, the cost of replacing the losing supply point was virtually zero. No? So in an arm's length negotiation over price, therefore, the supply points would have occupied a very weak bargaining position vis-a-vis TCCC. CEI DuPont, Dinemo, Owens and Company. No? It is inconceivable that price could be controlled without power over competition or vice versa. So in this respect, the butlers occupied a vastly superior position because they enjoyed de facto territorial exclusivity. They could restrict the extent of competition for sale of Coca-Cola beverages in their markets. So income tax regulations. And because the butlers created and managed their local distribution network, TCCC had few alternatives realistically available to secure local trade, marketing, and product placement in stores. No? So collectively, these economic conditions gave the butlers market power in their respective territories that enabled them to secure in negotiations with the company unequitable split of the system profit, sometimes as high as 55% in the butler's favor. No? So the supply points had no comparable bargaining power. So we find that the butlers and the supply points were reasonably perfectly comparable in terms of resources. Okay. Both sets of companies manufactured and distributed products in ARTD beverage business. They used a similar mix of resources to discharge these functions. Then the butlers were generally larger companies and their distribution activities were more complex. No? So they accordingly had many more employees than the supply points, and PPA represented a large percentage of their operating assets. But the two sets of companies were similar in terms of the relationship between their operating assets and their total resources. Okay, ano oras na?
1 hour 55 minutes.
So 5 minutes pa. The butlers were highly comparable to the supply points in terms of risk assumed. No? Both sets of company face the same risk to capital employed because they use similar resources to perform similar functions uniquely demanded by the non-alcoholic RTD market. No? Encounter ko na yan eh. Ano ibig sabihin yan? Yung dito, ano mo, yung ma-learn mo dito, yung dating documentation na requirement, ang tawag sa kanila, master platform document, no? So, yun yung magpapatunay na arm's length ang pricing ng company. No? Non-alcoholic ready to drink, no? So, yun po yung ibig sabihin ng NARTD. Non-alcoholic ready to drink. Okay. So Dr. Newlon observed, and we agree that the butlers, in some respect, assume greater risk than the supply points. The supply points operating assets included large amount of cash and accounts receivable from credit-worthy butlers. No? So malaki ang accounts receivable. No? The butlers' operating assets, by contrast, consisted chiefly of illiquid and difficult to repurpose PPE. No, ang hirap ng kanilang PPE. Other receivables from small retailers were subject to greater collection risk. The butlers also bore greater risk as a consequence of their more robust distribution functions. The supply points, in essence, had guaranteed customers. The butlers and the TCCC dictated the butlers to which their concentrate was sold. The butlers, by contrast, had no acquire and retail customers, secure desirable product replacement in stores, and negotiate favorable product pricing, particularly with smaller retailers. The butler's distribution function, as compared with the supply points, distribution function entailed greater uncertainty and thus greater risk. No? So petitioner contend that the supply points bore marketing risk because they funded consumer advertising in foreign markets. But the supply points had no operational responsibility for consumer marketing. They thus bore no risk in the sense of mission failure. Rather, petitioners simply charged certain Servco marketing expenses to the supply points, both, and it made these charges roughly concurrently with the supply points receipt of vastly larger amounts of income from the butlers. Petitioner controlled how much revenue each supply point received by shifting concentrate production among them and how much expense each supply point was charged, no, by way of demand fees and commissions allocated to it. Since the flow of revenue and marketing expenses to the supply point was controlled by TCCC, and since the revenue invariable exceeded the marketing expenses by a very wide margin, we do not see how the supply points bore marketing risk in any realistic sense. Risk is not something that can be assigned after the fact. No? So Dr. Newland acknowledges and we agree that the economic position of the supply points and the butlers differed in a few respects. Petitioner emphasizes that the two sets of companies occupy different points in the company supply chain and did not business at different levels of the market. Supply points sold all concentrate to butlers, and butlers sold finished beverages to distributors and retailers. No? But petitioner has failed to show how these distinctions affect the comparability of the functions the two sets of companies discharged or the operating profit they could earn. The supply points and the butlers both perform manufacturing and distribution functions in the non-alcoholic ready-to-drink beverage business, and both sold their product at the wholesale level. No? Petitioner contends that the butlers were marketing light businesses, no? Whereas the supply points assertedly had marketing-intensive operations as explained more fully below. We disagree with the former contentions. The evidence at trial showed that butlers in the aggregate paid about as much for trade marketing annually as TCCC and its affiliates together paid for consumer marketing. No? And the latter contention is simply inaccurate. The supply points did not have marketing-intensive operation because apart from the Brazilian supply point, they engaged in no marketing operations. No? So all consumers' marketing activities were undertaken by TCCC and the served cost. The supply points simply had this cost charged to their books via intercompany accounting. No? So in assessing the comparability of the butlers and the supply chains, we focus on the economic functions they actually perform, the risk they actually assume, not on intercompany charges made by their parent. No? So petitioners' experts develop various financial ratios involving revenue, inventory, asset turnover, fixed assets, marketing expenses, in an effort to show that the supply points were not comparable to the butlers. Some of these computations relied on questionable assumptions. For example, Dr. Timothy Lerman calculated that the supply points receivables represented 33% of their adjusted total assets, whereas the comparable figure for the butlers was 15%. But as Dr. Newland noted, the receivables shown by the supply points may include items that were not trade-related and are settled in the ordinary course of business under normal commercial terms. No? So Dr. Lerman calculated that the marketing expenses as a percent of net revenue were 30% for supply points and only 20% for the butlers. Okay. But as noted previously, this ratio is not meaningful for the supply points because they did not themselves engage in similar marketing activities. They might have marketing cost assigned to them because petitioner had complete discretion in deciding how many dollars of marketing cost would be assigned to each supply point. These numbers have no grounding in operational reality. No? So, kunti na lang to. Anong oras na? Tapusin ko na lang to.
2 hours, 4 minutes.
Mga 2 minutes lang to. Para yung sunod natin, data assumptions and comparability adjustment. Yan na yun, no? Naggawa na tayo ng transfer pricing methods. Yung susunod na, paano sila nag-adjust, no? Kasi di ba in-adjust nila itong payment of royalty. So Dr. Lerman also calculated that the net revenue as a percentage of adjusted asset and PPA was much higher for the supply points than for the butlers. But these ratios have a question-begging aspect to them. The supply points net revenue consisted chiefly of the concentrate price paid by the butlers. But by paying the concentrate price, the butlers secured not only the physical beverage base, but also the entire package of rights and privileges they needed to operate efficiently as Coca-Cola butlers. No? So noting that the transferred property may include intangible property embedded in intangible property. This package included the right to use TCCC trademarks, access to TCCC approved suppliers, access to critical bases and marketing materials, and the expectations of ongoing consumer marketing support from TCCC and the served cost. In short, the net revenue received by the supply points was artificially inflated. Ayan ha. Because it represented compensation to petitioner for its intangible contribution as well as to the supply point for their manufacturing activity. Since the supply point's net revenue was artificially inflated, financial ratios with net revenue in the numerator do not furnish useful evidence in judging the supply points, comparability to the butlers. So indeed, the objective of this transfer pricing exercise is to ascertain an arm's length division of concentrate revenue between petitioner and the supply points. No? If Dr. Lerman had used net revenue less arm's length royalty as the numerator in these ratios, those ratios would look very different. No? So financial ratios can be useful, but depending on which ratio one chooses and what assumptions and adjustment one makes, they can be used to support rather different conclusions. At the end of the day, we did find the financial ratios constructed by petitioners' experts to have much probative value in determining the butler's comparability to the supply points. Comparability under the regulations is principally based on the basis of functions performed, contractual terms, risks assumed, economic conditions, and assets employed. We found that the butlers highly comparable to the supply points in all 5 respects. Although considerably there are differences between the two sets of companies, we find on balance that these differences tend to make the butlers deserving of a higher ROA than the supply points. To that extent, Dr. Newlon CPM will tend to overcompensate rather than to undercompensate the supply points, and it is therefore conservative. So in this case, pinanigan ng korte yung expert ng IRS. No? Yung next po natin na pag-aralan is the data assumption and comparability adjustments. No? How the IRS makes or adjust, no? At ano yung in-adjust nila? The profit. No? Okay. Okay. So, ilang oras na tayo?
2 hours, 8 minutes.
Okay, so with that, I would like to say thank you everyone. Ilan pa yung viewers natin?
7.
Reminders pa rin kasi malapit na yung ating filing ng income tax return. So, please lang, yung mga ginagawa natin na mga documentation, umpisahan na po natin gawin so that by the time na nandyan na yung deadline natin ng ITR, available na rin yung documentation po natin for transfer pricing purposes kasi sabay po natin silang i-file. No? Thank you very much and good evening.